Welcome to the Gray Report. I'm your host, Spencer Gray, joined by Director of Communications and Marketing at Gray Capital, Matt Bosnagel. If you are a multifamily investor, any kind of real estate investor, whether you are an aspiring, fully active, work in the industry, just casually interested, this is the YouTube show and podcast designed exactly for you. We are covering everything that's going on in the multifamily industry, real estate, and the economy, trying to give you all of the tools that you need to make the right and informed investment decisions, how to chart that course. In insane times right now. The markets are all over the place. You got to be looking at some empirical data, some really intelligent opinions to be able to really kind of figure out what the next moves are, because there's a lot of opportunity out there, but you got to approach it the right way. Matt, really interesting reports today. We've got Globe Street, Forbes, some of the Dallas Fed, the White House, Capital, Spectator. Really great reports. Let's just get into it. All right, welcome back to the Gray Report. Matt Bosnagel coming back fresh off a spring break vacation. You've got some really great reports that we're going to go over today. I spent a lot of time last week talking about, the fact that interest rates are rising. There's a lot of volatility in the market, and, we're just in a different world than we were just a couple weeks ago, especially a couple months ago. Seeing, not, I wouldn't say, cracks in the wall, but definitely we've already seen some movements. Some prices aren't going way over ask, and maybe they're coming in right at ask. Mm-hmm. I would say maybe a closer return to normal, not the insanity. I guess you could call that a little bit of softening in the market, but I think it's kind of a welcome respite from what we've seen over the last couple of years. Yeah. What else, looking at the reports, looking at the feeds, what do you see kind of coming in, changing over the multifamily industry since you were here 2 weeks ago?
So, I think that it's worth thinking about what are the lagging indicators and what are the leading indicators. Mm-hmm. It does seem like we are more and more people are talking about the potential for recession. Maybe it went from everyone's talking about inflation, and now they're talking about there was just a New York Times article that I got in my inbox. It's like economists are talking about recession. I think the environment's changed. I think that people are putting the likelihood at maybe in the 30s or 30%.
Yeah, I think I saw that. But, 25, 30%.
Regardless of what number you put on it, the interest rate hikes has made it a different environment. That's this material thing that's going to matter tomorrow rather than, late 2022 or 2023
we
or whatever.
We saw the yield curve invert, the 10-year Treasury minus the 2-year Treasury. Spoke about that last week, and, I think that we saw another move in the, 10-year Treasury. I think it's at 2.67% right now. Back early in March, it was 1.7% or so. Yeah. In the Federal Reserve, we saw from Fed board member Brainerd. She said basically yesterday that the Fed was really going to be starting to work on unwinding that balance sheet, selling bonds, and that could mean that the prices of the bonds could go down and the rates could continue to go up. So definitely something to watch. I mean, we are really tracking the different financing rates and how it affects multifamily, because again, talking about if you're buying with these incredibly low cap rates, you only can really make sense of it if you're getting cheap, debt. Yeah. And the last 2 years, it's basically free money, 2% debt, 3%. It's basically free money. Yeah. It is no longer free. And so it's harder to make sense of a 3% cap rate if you're borrowing at 5% these days.
Yeah. I think that it does put a little more risk in the market. Mm-hmm. It makes it, it thins the margins, and it makes it so that you got to really find a better deal rather than there's no reason not to.
Exactly. I think that all the speculation that's been going on, I think you have to be a little bit more cautious. Yeah. Now, at the same time, when we've got reports that we're going to get into here in a minute, we're still seeing really strong rent growth. And this inflation, which is the cause of all this moves, is really pushing that top line
and
growth.
That's what I wanted to note, too, here. I have a little paragraph at the beginning of my notes here. It's like I could have included a couple of articles that I just didn't have room for. And one was that there is still an incredible amount of investor attention in the multifamily market specifically, and the apartment demand and occupancy numbers are going gangbusters.
Yeah.
So that multifamily market right now is doing great, but I think this is it. It only makes it more important for us to really study this moment and see where we're going.
Yeah.
Because I think because you don't want to buy at the top and then have to wait in the bottom for a year and a half for things to even out.
Well, and I've been writing a letter to our investors, kind of observing and giving our comments on the risk factors and how we're kind of taking steps to mitigate those risks. And one thing that I wrote is that because exactly what you said, it's like the fundamentals of multifamily are still very strong. You can have the right investment thesis, but you can have the wrong strategy or the wrong tactics and still finance it in a way that opens you up for so much risk.
Yeah.
And there's a lot of strategies out there that to mitigate that risk, whether that's going fixed rate, buying caps, using options, in your kind of level of sophistication, kind of needs to be up a certain level to maybe take advantage of some of those resources.
Yeah.
But I would say at the same time, when you're, taking extraordinary steps to make things work, they wouldn't or otherwise ordinarily do, you have to start asking yourself, is this right?
Yeah.
But the way I see it is it's that the fundamentals are so strong. If you take a long-term approach, the decision where to invest is pretty simple. It's just how to do it in a right way to mitigate the risk is a challenge, and it's not the easiest thing to figure out right now.
Yeah, and we've said this in kind of personal conversations is, the not acting, doing kind of a wait and see is as much of an active decision as choosing to act.
Yeah, I mean, if you're in cash and you're losing 8%, 10% because of inflation, that is not ideal.
Yeah.
Well, let's just get right into the reports. The White House put out their proposed budget for 2023. First, we'll just start with the Globe Street article, kind of giving things a quick summary, and then we'll actually get into the budget itself as how it relates to multifamily and real estate. It's a lot of the stuff that we were talking about last year.
Yeah.
I don't think hardly any of it's going to happen, Matt. But what does the Globe tell us? What Globe Street is highlighting?
The Globe. You can look at the budget, and we have a link to the budget. We can provide that in the show notes. But basically, it says that this exchange. It talks about 1031 exchange, and it says they look good on paper because they reduce the budget, but there are too many powerful groups that oppose the changes, so they will not pass. That's one of the industry experts that they kind of polled for the opinion on this issue. It does seem like we're coming into a midterm election. I don't think that people necessarily want to rock the boat, and you've got a razor thin margin in Congress that and there's probably some Democrats that would not want their 1031s or whatever tax deductions that they're using. They don't want that to go away.
Yeah, we talked about this a lot last year. It put a lot of shade on the market, or just it held up some decisions, maybe even accelerated some decisions because people saw capital gains taxes going up, maybe even going retroactive. Getting rid of the 1031 exchange. And as Globe Street pointed out, a lot of this has now been thrown back on there.
Yeah.
Oftentimes, these budget proposals from the White House are more of, they're more positioning of their policy, what they would like to see.
It's not aspirational.
Exactly. It's very aspirational. It's not necessarily this is something we think is going to get passed, but like, wouldn't this be great? Yeah. Let's take a look at that, and because the point that you made, just while I find the section real quick, the point that you were making, I think, is really, really important and can't be understated. What can be passed? That you can have, any type of budget and law and resolution can be proposed. It doesn't mean it's going to go anywhere. We got an election coming up in November, and
I think that some people, this is the cynical take is they want to get caught trying. Yeah, they know it's not going to pass, and they want to get credit on kind of both sides. Like, well, nothing happened.
100% agree. But let's just look at what the kind of agenda is and what is on the chopping block to take a look at, because I think that it is, well, it really reminds us from last year what we were looking at. So looking at these they're going to close some loopholes, here at the top, and then these numbers are in millions. So we've got, a couple $100 million each year for just looking at closing the tax on carried interest. Now, carried interest is essentially what syndicators are making, and anyone in the private equity space taking their carry or their promote, or it's the split. If you look at apartment syndication and then maybe there's a 70-30 split, maybe it's 80-20, something like that. That 20 or that 30% that the syndicator gets, that's the carried interest. And so they basically want to tax, typically that it's taxed at a lower rate than ordinary income. And they want to tax it at ordinary income, get these fat cats on Wall Street, as they would say. It's going to bring in a couple $100 million. Is that, I'm wondering if that's really worth it or not for them to do.
Well, yeah, because and just for the podcast listeners, it also lists next to it. It's how much money it will save. So they have negative 406 in millions. So negative 406. So it will reduce the deficit, they project, by $406 million if they eliminate carried interest. That's a lot of money, but that's certainly a lot less.
It is and it isn't.
Yeah, it's certainly a lot less than if, they also had that plan to strengthen taxation of high income taxpayers. That's at what? $29 billion?
Something, yeah.
So the proportion is, it's a small pool, and if I was fighting for something and I really wanted to balance the budget and to reduce the deficit, that's small potatoes. That may be too much of a heavy lift, and not cost benefit is really low on that.
So, and that begs the question: what is the goal here? Is the goal to balance the deficit, Matt, or is the goal to
kind of punitive?
Be punitive and really be virtue signaling.
Yeah,
is that really what it is?
Yeah.
I think that's really what it is. Because if the goal is to reduce the deficit, we're not really seriously talking about it. We're chipping around the edges, and we're chipping around the edges of parts of markets that are really kind of the drivers of innovation and allocating capital. And if you want a functioning market, you don't go after those market makers.
Yeah.
It's easy to say fat cats on Wall Street, but it's how things are. It's really how the economy works. And do you want to penalize people from engaging in economic activity? I don't think that's a good strategy.
And that's another thing. It is like, what kind of, even whatever your intention is, what kind of behavior is this going to discourage or encourage is really important. And it's definitely probably going to outweigh the benefits. And
we're going to get to some other things specifically related to real estate. We're just going to go down the list real quick. But again, so we're in a housing crisis, right? We need more investment in housing, not less investment in housing. Yeah. And pouring some water on housing investment doesn't seem like the right way to increase investment in housing. So let's look at some of these other line items. The big one, talking about the repeal, deferral of gain from like-kind exchanges. We're talking about getting rid of the 1031 exchange. It's going to bring in they're saying about $676 million projected in 2023 is what they were saying the first year, and up to $1,857 million by year 2. Basically, they're saying it's going to reduce the deficit by about $20 billion over 10 years. Again, $20 billion is a lot. It's also it's not that much. And you think about the entire federal budget.
Yeah, I mean, it's easily about 20 times less than some of these other items in the budget.
Yeah.
So
again, talking about, do we want investment in housing or not? And I think the point that we've made quite a few times is, whether it's Republicans or Democrats, a lot of these people own real estate, and getting rid of 1031, that would really kind of throw a wrench in a lot of folks' gears. Now, we don't use 1031s that often in syndication. It's going to be more complicated. That doesn't affect our business, but it certainly has been a tool that the government created to encourage investment in real estate, and we still want people to invest in real estate. There's a handful of other deductions, they've talked, and not necessarily related to multifamily. But one thing that I think is interesting is that talking about extend the period of assessment of tax for certain qualified opportunity fund investors. And then there's anything from, limit the use of donor advised funds to avoid private foundation payout requirement. These are all things related to, quote unquote, close the loopholes.
Yeah.
And raise revenue. What are they raising revenue for? That's not exactly clear, but that's always a question I like to ask.
And the sum total of that section is $68 billion, as far as I can tell there, and that's a lot less than some of the other sections.
Yeah. So we're going to watch this. I think, as we said that earlier on, I think it's interesting to look at this. I don't think any of this is going to happen in an election year. It's going to be all stripped out, and I don't think the Democrats are going to be able to pass really much of anything.
And we could say it's a nothing burger and dismiss it, but I still think it is worth. That's what they're talking about.
Got to be aware of it,
and
for sure.
You got to see it coming if the voices get louder or anything. So
I agree.
Yeah.
So back to our conversation where I was having with myself last week, and our continuous discussion: what rising interest rates mean for apartment cap rates. I think it's a great question. We were just talking about this. Cap rates in the 4% or below now, with interest rates in the kind of the mid 4s to 5s. You got an inversion cap rate interest rate spread. You've got using negative leverage. Doesn't make as much sense. Matt, what's your take?
It's like when you get it's like I have a bad metaphor here, but bear with me. If you get they're trying to put these limits. I'm not going to use this metaphor, but they're trying to put limits on this and trying to reduce demand. And one of the areas of demand could be investment demand, but it almost looks like people are so hungry for these investments that they're going to eat right past it. That these little restrictions aren't, according to this article, aren't going to do much to reduce cap rates.
Yeah.
And cap rates as a sign of the demand in the investment market from investors, they sure are painting a sunny picture. And I wonder if cap rates are going to change a little bit once the full interest rate regime kind of gets implemented.
Yeah, I think those are all good points, and I think it's also, I think we should step back and looking at cap rates and interest rates is kind of a snapshot in time. Yeah. It's like looking at a picture versus watching a video, because in an apartment investment or real estate investment, it's not just I buy at this cap rate and that's my return forever. And cap rates are often misconstrued with like what your return is, and it's correlated, but it's not the exact same, because you're usually going to execute some kind of business plan. And the variable that has to be thrown in there is inflation. Yeah. And you may be paying a higher interest rate and you're buying on a low cap rate, but your revenue growth is so much that it offsets that.
Yeah.
Theoretically. Now the concern is you pay a high interest rate, low cap rate, and that growth slows down quickly. And then you're paying a high interest rate that would reflect inflation, but that inflation all of a sudden doesn't show up.
Yeah.
That's where you could get into trouble pretty quickly. But I could see even cap rates rising because buyers just won't be able to speculate as much. And what we've seen over the last year of where multifamily properties in single-family homes and other real estate have been trading for 5-10% above what they're like the whisper price, or kind of what the asking price. Where before everything kind of traded, usually they went for the price they were asking, plus or minus, usually maybe a little bit below. So now we kind of come back to where they're still hitting like their prices, but just the rate of growth is slowed down, and we see cap rates rise, but you're still seeing the rent growth and inflation. And so, looking at the cap rate formula, we're taking our net operating income, which is, your income minus your expenses essentially, divided by your cap rate. And the lower the cap rate, the higher that value is, or the lower the cap rate, the higher the value is. The higher the cap rate, the lower the value it is. You could have a higher cap rate, but if your numerator is increasing, that net operating income, you could still have the same value or a even higher value, even with a higher cap rate. But you have to have the income and the net operating income growth to offset that. And that's the question: are we going to see more of like prices flattening off as we see growth as cap rates rise related to interest rates, or is what you're suggesting and many others are suggesting, there's just where else are investors going to go? People are going to keep flooding into multifamily, seeing it as just a safe haven asset and keeping those cap rates compressed.
Yeah,
that would be incredible, and we shall see. We're kind of uncharted waters.
I think it's hard for me to think that it's not going to cool off the market a little bit. So,
and I think it already is.
Yeah,
and just anecdotally, like I said earlier, I've heard now offers aren't coming in way over whisper now. They're coming in at whisper. We've heard some people talking about throwing in financing contingencies, which haven't been used in the past.
Yeah.
And even some people, some deals being backed out of because all of a sudden they don't work.
And I know I said this before, but these are the kind of things where, your human emotional brain is a little bit easier it's a little easier for you to understand this and how things are moving than if you were Zillow trying to, put a number on things or trying to calculate what the feeling of the market is.
Yeah, no, I think that, intuition has to be part of it. And even beyond intuition, it's just that collective investor psychology. People just start getting scared and they're not reaching too much. But I don't know. I've heard a mixed bag. Most people who are in the multifamily industry still see the fundamentals and they want to get in for the long run. They just don't see things changing because they see so much demand and growth. Yeah. And we've looked at there's way more renters than there used to be buyers because people can't even afford to buy a single family home. So there's just a much larger pool of renters out there, which is continuing to drive demand. So it's really kind of cutting two different ways. Yeah, your cost of borrowing is increasing, but just looking at the underlying fundamentals of demand for rental properties is still at an all-time high.
Totally, and there's no sign of stopping in the near or medium term. Really.
Yeah, I think this is a good transition to this next piece from Forbes. Rents look set to rise. Does that make sense? Rents look set to rise. Will government do the right thing? By Roger Valdez. He's the director of Seattle for Growth. Still seeing strong rent growth, it appears, in the market. That's what we're seeing in our properties. That's what we're seeing in the market. Still very, as we were just talking about, very solid demand. But what's your takeaway, Matt?
So just reading the title alone, I was talking to you about this before. It's one of the better kind of fake outs that I've read. And a couple of weeks ago, we went over that 60 Minutes piece that really is the typical framing of rents are rising. What's government going to do? And asking, will they do the right thing is assuming that they will get involved more. And that is, you already know what the framing is. Like, well, government's going to fix it for us. And it has, that's a question that sparks so much government involvement. It's, the lead into all of these calls for action or regulation or whatever kind of Band-Aid solution, basically, that they want to provide for renters, with the assumption, kind of, that investors are the driving force behind the problems that renters face.
It's not anything else that happened. It's not the eviction moratorium or the money that was created or any of that.
Or the large generational long-term simmering problems that have...
or the billions of mortgage-backed securities. Anyway, continue. It's the investor's fault.
Well, this article does not do that. It was not a bait and switch, but more of a it baited me.
There you go.
And honestly, and I'm going to cite this specifically. This is from Roger. I think it's Roger Valdez, the author here, and he's the director of the Center for Housing Economics as part of this Seattle for Growth nonprofit. He gives a pretty clear-eyed take on some of the housing trends that we've seen developing here at the Gray Report. First, he discourages new government policies that would punish new investment in housing, and he suggests that we're probably likely to see a heightened pace, or more voices calling for rent control or subsidized housing, instead of loosening rules and regulations that already make building already difficult. Yeah. So
he's out of Seattle, so he really is front and center to all of that, where there's been a ton of NIMBYism. It's hard to develop. There are degrees of rent control in the Pacific Northwest, especially, Oregon. And so... And
there are a lot of people that want, this is a nonprofit, and I don't know, maybe it's funded by a bunch of... I see them as in line with a lot of housing experts that want to make housing easier for the individual person. And they've discovered that the best way to do it is to allow denser housing, so kind of freeing up regulation and making it easier for people to build, instead of basically giving people more money so that they can pay rent.
Yeah. So actually going to the root of the causes instead of little Band-Aids of the symptoms.
He said, and I'm just kind of quoting this because I think he puts it better than I can paraphrase here. He says that the COVID-19 crisis saw many people learn that all levels of government do not take paying rent seriously. Eviction bans led to non-payment of rents, which harmed many housing providers and has added even more risk to owning and operating rental housing. We talked about this. Without efforts to shift the narrative, again, so that the public understands that rental housing is a marginal income, not a passive income business, that is a business that must generate revenue to exist, it will continue to be easy for politicians to overregulate and punish housing investors and providers and then dump money on nonprofits to offset the inevitable inflation. My take of that is this idea of it's marginal income, not passive income. Marginal income means basically if the numbers don't work right, it's not going to happen.
Yep.
It's not, and passive income maybe assumes like, if the numbers don't work right, it can coast for a little while. Don't worry, I'm getting this passive. It's not, it's not my bread and butter. It's just something extra that I get. This can kind of run itself. But you need this money in order to continue to operate.
Well, I think it's the margins on rentals are not that wide.
Yeah.
And, a lot of the money, especially in Seattle, in a lot of tight markets, it's not necessarily from the cash flow. I mean, you're getting some cash flow, but it's relatively low. The margins are relatively narrow. Mm-hmm. Most of the profit, especially in those types of markets, are all coming from when you eventually, sell or, refinance at a capital event. But to your point, they have to be profitable. They have to actually be somewhat cash flow positive to make sense, and they're not passive. You can be a passive investor in real estate, but someone is collecting rent checks. Someone is fixing up the property. Someone is managing, monitoring, conducting maintenance, and that all costs money. Those are all salaries. And those all have input costs, and especially in today's market, with margins being so thin, you add regulations, you increase the cost for these businesses, for rental properties, you are going to significantly stymie, the investment. And when we're seeing cap rates so low that the prices are already high, it's not like there's much room for error.
Well, and that's what the following paragraph that he says after, talking about marginal versus passive income, he says that, these punitive regulations is going to make the costs even higher. And combine that with subsidies, giving money to people. We've seen this with higher education. You give people money, that rises the prices even more. And it said, which tragically will lead politicians to pour more money into subsidies. And then this is what I think is particularly interesting. He says, when only large corporate interests can sustain private housing, then the government could intervene and take over much of the housing in the country. That may be like a little bit of a worst case scenario, but it does seem to be, what if it becomes only 2 or 3 institutions have the pockets to make these very, very, very thin margins work, and then you get a little bit more of like a market capture, and it could reduce new investors, and this kind of regulatory capture could really be a serious problem.
Well, we should bring Jay Reeder on to talk about this. He's our senior vice president of acquisitions, and this is something that he's been talking about recently. He's been predicting now, especially right now, is a major consolidation in the multifamily industry for exactly what you said, is that there's only going to be a handful of companies that can handle the lower margins because of economies of scale. They're larger. They've got the cash, and we're seeing it right now. What we're seeing is kind of the groups that kind of have, they've got we got to hit return hurdles like a Gray Capital. It's like we're trying to hit certain returns for our investors. Now, some of these other groups, their either return thresholds and criteria are much, much lower, or they're really just focused on, accumulating assets and, building their book of assets. And they can overpay, they can buy at these lower cap rates all day long, and they can operate on even lower margins. And so you are going to see a more consolidation. I mean, right now, it's an incredibly, fractured industry. I mean, there's certainly some big players out there, but it's very fractionalized, very local. And if you go to, like a Europe, you see, a little bit less of that. And you see, it's all of a sudden it's going to make the insurance companies going to be directly owning, all the real estate, or these big institutions, private equity firms. And it's going to really eliminate a lot of the, not just like the mom and pop, but just a lot of the middle market investors, which is, drive a lot of the investment into housing. And again, we need to maintain the housing stock. We need to build more housing stock. Otherwise, what do you think is going to do to the price of housing?
Exactly. And you know what, maybe from the perspective of a renter, who cares if they're buying, if the ultimate owner of their apartment is one of 3 corporations or one of 100 smaller corporations? They maybe don't care, but they do care about their rents. And if it's one of 3 corporations, what if we're in this situation where like Okay, now they own all the apartments in Atlanta, or what? Maybe not Atlanta, but
Well,
they,
sure,
in a
or, yeah.
specific market. You know,
Or
they
a
own
third.
even if it's just a third, they have so much power
Yeah.
to raise rents and do things, you know, that
Yeah.
are apart. Whereas introducing competition could make things a lot easier.
Because right now, like a lot of the mom and pop folks, you know, they haven't raised rents that much.
Yeah.
You know, that's an opportunity for maybe some buyers out there, but that is keeping things, you know, still relatively affordable.
Mm-hmm.
Mostly because they're, you know, either not as sophisticated, they don't know that rents have moved as much, or they have no desire, they don't need to. They just want to kind of keep things rolling as is. But if you just have a small handful, they know what the market rent is, and that's what rent's
Yeah.
going to be.
Yeah.
You know, and they're probably going to be used more automated, you know, revenue management systems that are just going to track the market on a day-to-day basis.
Yeah.
And you don't even have a human really behind the wheel anymore, just whatever the market is.
Yeah.
And when you see those those systems turned on, rent rises significantly because the market's usually moving much faster
Yeah.
than the property managers who otherwise would be setting that rent, because they're just kind of seeing sort of what the comps are doing, getting their best gut, and then they also have, you know, personal connections to the residents. Or
Yeah.
do I want to push
You want
it?
to keep the human in the equation.
Yeah.
Call me old fashioned, but you know, I think that there's a ways to go with the metrics and stuff, but also like you understand a lot more than if you were going by what a program's going to tell you.
I think there's a lot of merit to the revenue management systems, because I've seen just them be extremely effective. But you have to have a human involved in watching what it's doing, because it's, you know, bad inputs, bad outputs,
Yeah.
you know, garbage in, garbage out, and you have to make sure that what it's spitting out makes sense. And you also don't have to let a algorithm decide everything for you. You know,
Yeah.
it's like, okay, this is where market is, but do we want to actually move it there?
Yeah.
Maybe often you do, but you don't always have to at the same time.
Yeah. So in general, I really like that article, and it's going to be on the top of my mind for a while for sure.
All right, let's take a just quick look at the U.S. Business Cycle Risk Report. Now, this gets put out by Capital Spectator. I mean, this is like, you know, a private report, but we want to just, you know, share a little bit about what we are watching and trying to just stay on top of the macro. You know, really looking. A lot of this has been focused on, you know, potential risk of recession. You know, how the war in Ukraine is really throwing a wrench in the gears in the global economy.
Yeah.
Matt, I sent this to you on Sunday. What was your takeaway?
Yeah, this Capital Spectator newsletter, I'd say it's worth the money. They dig into it really well. I think it's a topic that is that's only increasingly relevant, and I think that they provide great clarity as well as a good amount of relevant, really detailed information on the economic risks that we are facing. Right off the bat, they say that the recession risk is low relatively. I don't know if they gave a specific figure, but it's probably, you know, 20 to 30 maybe. But the economy is slowing somewhat. When I get emails from the New York Times about economists think that there are recessions, that's a different flavor of economic reporting than we'd seen earlier this year, and especially as this article notes, job growth is going strong. And even a couple weeks ago, you talked about how job growth could be a lagging indicator, but we're seeing some dissonance when it comes to these, you know, these economists are predicting the future, that we are predicting some kind of headwinds, and then you see on the other hand, you know, unemployment figures are low. There's still great job growth that is going on. So I think that a little bit of the kicker here is interest rates. There's a sense here that the Fed doesn't want to overreact or set off a feedback loop. So they're saying, and I think rightly, that there's going to be probably some limits to the Fed's interest rate schedule. At the same time, they're not seeing a pullback in rate hikes until the second half of 2022 at the earliest.
Well, what I keep hearing is we're going to tighten until something breaks.
Yeah.
We're going to keep tightening until, but it's, do they act with enough foresight to usually they've broken it, and now they're having to play catch up. I mean, they're playing catch up right now. I mean, the situation we're in, it was transitory. Now it's not transitory.
And just to extend, this is probably a bad metaphor. You know, if we're talking about 2 or 3 people or 2 or 3 companies controlling the housing market, they don't know all the individual humans that are involved in rental housing. How does a group of people know all the individual conditions in the economy? They're not going to get it perfect for everyone.
Charts and graphs and rolling the dice.
Yeah, it's going to be uneven, I think. Whether it's a recession or whatever, it introduces uncertainty in the market.
And one thing I think it's just important to note, and just so we're looking at, they have a bunch of, recession probability indicators. One thing that I've learned from looking at recession probability indicators is that they don't work until you're basically in a recession.
Yeah.
And everything is fine until you're in a recession, and it can turn on a dime. And the problem is that things are too good right now.
Well, and this is
too hot. The economy's too good.
For the past month or so, since you've kind of lit a fire under us and really opened our eyes here at Gray Capital, and I think for listeners of the Gray Report. But now I'm reading these headlines of job growth and of great, of market resiliency, if you will. Now I'm thinking, well, is this what they read right before the recession? Is this the kind of foolish headline that we're going to look back on and say we did not get this right? So as long as I'm thinking that, then I feel a little bit better that we can kind of adjust and react. But that's what's going through my mind as I read good things. It's like, is this hubris?
Yeah. I think, and we've talked about this a little bit, it's almost like when someone calls for a recession, it's like, I think the probability of recession maybe goes down.
Yeah,
Same thing.
yeah.
It's like people say there's a housing bubble, and it's like, okay, if you try to say that there's a black swan, you see that means it's probably not as big of a deal, and we're probably misinterpreting.
Yeah.
It's the ones that we aren't not anticipating are what actually get us.
And that's why it's a little comforting to guard yourself against it, because at least if you can predict, if you can kind of see it coming and take actions, that's a little bit more reasonable, a little less uncertainty.
Yeah.
Than that could maybe even stabilize things. But I still think that there are some worrying parts of the economy.
Yeah, and that's why, and we didn't mention the letter that we're going to be sending out to our investors, and we made a video about it that's going to be released soon, is that we don't have to take, extreme positions in binary positions.
Yeah.
It's, how do we continue to take advantage of the growth that we're seeing in the market and the economy? Because again, the fundamentals are very strong. How do we take advantage of that while protecting, the downside? Because it's right now it's kind of like the risk is like kind of to the upside because of just it's too much growth. And we just have to look at the market differently than we have been looking at it in the past, and acquisitions differently. And because there's a bunch of analogies that have been kind of floating around, and it's like, it's a lot of it is, it's like looking at the weather, and it's like, you see some clouds, forming. It doesn't necessarily mean there's going to be a tornado, or there's not going to be a storm, but it's like, it might not be a bad idea to like have a rain jacket.
I got one. I just thought of one. If there's like this asteroid coming to hit us, we put a little rocket, just nudge it slightly out of the way. If you see it coming, a small amount of work is going to help you a whole lot later if you see it soon enough.
Well, I think it's a great point.
That's probably a bad metaphor. Though.
It's fine. I'm thinking like, well, we'd be able to more accurately predict the trajectory. Yeah. But it doesn't matter. But it's what we're just seeing, just as practically, we're looking at our models, and we're modeling out just what are very possible scenarios right now. Looking at the Fed dot plot and seeing, kind of the highest range of what the Fed Board of Governors is saying, it could be all the way up to like, 3.1% on the Fed funds rate. You take your floating rate loans and you add on, 300 basis points over your spread. You're kind of in the mid to high fives.
Yeah.
Even maybe up to 6%, depending on who your lender is. And man, you know what? You were probably underwriting a 3%, 3.25, 3.5 to 4%. Your interest that you're paying could double. Your debt service could double, and you weren't planning on it. And I bet your cash flow may not be able to catch up.
Yeah.
Theoretically it should, because we're seeing that much inflation. We probably will. But when you can start, what we always like to try to, break our models and stress test them. What's going to get us into trouble? Because then we can start mitigating and, protecting ourselves, from those occurrences to happen. And with these low cap rates and rising interest rates very quickly, that you need to have a lot of things right in a short period of time, or you could easily see you being below break-even occupancy. So we're structuring deals right now of like, how do we just remove that possibility? And part of the result of that is taking a little bit lower return, because we're going to go in, we're going to lock our interest rate right now, as opposed to, speculating on, where rates are going to be in, a couple months or a couple of years from now. There's some other strategies. If you do use floating rates, there's certain types of hedges, whether it's buying caps, you buy options on SOFR. There's all kinds of different ways to do that. But if you leave yourself unexposed, you've got this, exposed flank, you could all of a sudden see something come up to bite you if you're just complacent in the market right now. And again, in the letter, and if you're signed up for our newsletter, graycapitalllc.com/newsletter, you'll probably get this letter, especially if you join the investment club. I'm the biggest risk to investors investing in passive investors, limited partners, investing in syndications right now is complacency from syndicators.
Yeah.
They're focused on really two things. They're focused on raising capital and winning deals. They're not always like they should be focused on risk mitigation, and they're using the same playbook, and things move so quickly. There are deals in progress right now that were put under contract a couple weeks ago or a month ago that the strategy that made sense a month ago doesn't make sense right now.
Yeah.
And how many people are just moving forward and how many people are changing course?
That's what I was going to say. It does when, this first rate hike really made things real. I bet 10,000 spreadsheets across the country have changed as a result of this. Before we were just kind of talking about it but like once these things get real and you see how, the federal interest rate trickles down to like the actual real interest rate that you'll be paying, that has an effect. And like you said earlier, I wonder if it will normalize the investment landscape a little bit.
I think it could. And just looking at the different interest rates, because some different maturity interest rates are more market influenced by the market rather than completely artificially, by the Federal Reserve. So I think the shorter maturity interest rates are more linked to the Fed funds rate that the Fed just decides where that's going to go, or they vote on it. And so like SOFR is basically tied to the Fed funds rate, and that's what most like floating rates are based on. But like once you get out kind of like the 2-year maturity all the way up to 10-year, it's really much more market driven. And that's where we've seen the rates really increases on that 10-year, and even on the 2 years and the 5 years. I mean, we saw the 2-year Treasury yield being higher than the 10-year, and then that's changed because the 10-year popped up again even more. It was 2.5 on Friday. Now it was like 2.67 today. The 5 years are like 2.7, so the 5 years higher than the 10-year. And those are more forward indicators and predictors of where rates are going rather than the shorter term rates themselves. Now, but we can also look at the futures markets and the options markets for those shorter term rates to get a little bit of an indication of where the market thinks that they're going to go. Yeah. So you can go to, just like the CME, the Chicago Mercantile Exchange, or the CBOE, the options exchange. You can look at where SOFR, for example, is trading at a like a 1 year out basis, 2 year basis, and it's already trading a little, right around 1%, 100 basis points. It's only at 30 basis points today. So that's basically going to see a tripling. The market is already assuming a tripling, but the Federal Reserve is seeing up to even 3 times more than that, getting all the way up to 3%.
So you just threw a lot of numbers at me, and I'm very curious. What
we need to reel it back in, slow down.
Well, I just wonder, where do you think? Now, this is putting you on the spot. Where do you think the interest rates are going to go? How much do you think of an increase would it take for an average syndicator, or how much? What are they going to experience by the end of the year?
I mean, this is not my opinion. I'm just going to tell you what the futures in the options market is telling you. It's going to be around 1% on the Fed funds rate. Right now, that's what the future markets are telling us. I think a lot of people are saying it's going to be closer to 2%. I think so. Really, kind of 1 to 3% is the range that we're looking at right now.
So does that, you just tack that onto existing, or is that multiplicative when you're talking about translating it into real interest rate that people are paying?
So I mean, that is the interest rate that they'll pay plus their spread. So you're paying, call it a 200 basis point spread or 2%. Plus whatever the underlying index rate is. So if it's 1% on the index rate, you got a 2% spread, you're paying 3%. That's actually not that's really not that bad. The spreads usually aren't that low right now though. But if SOFR gets up to 3% and you're paying 200, then you're paying 5.
Okay.
You could be paying a 300 basis point spread, and then you're paying up to 6%.
Okay.
So it's now the other variable in that is how will lenders react to those spreads? And we're already hearing from the agencies, Fannie Mae and Freddie Mac, that they may even kind of reduce those spreads. And we've already received quotes that they are going to increase the amortization from a 30-year to 35-year. The reason for that is the agencies have a certain they have a quota of how much they're supposed to lend. Because they're government-sponsored entities, and they're supposed to be there supporting housing. They haven't been as competitive because so many people have been using bridge loans. Because of the flexibility, you can get out early, and with the idea, which again made a lot of sense over the last 2 years, and it's what we've been doing, is you're seeing this gap up in terms of cap rate compression, and you're also seeing all this rent growth, and so your value in 1, 2, 3 years is going to be substantially more of what you purchase it, and you want to be able to either have a capital event at some point. You want to refinance, or you want to just take it to market and sell it, because you're going to get so much growth in a short amount of time. In bridged loans, have just been more competitive than agency loans.
Okay.
Now the agencies have to make up for that because they haven't lent as much as they've been used to lending. Because in a more stable market, the agencies make more sense because it's like you can lock your rate in. It's relatively consistent. You're not seeing this big leg up. But now those bridge loans, they're almost always floating rate loans. But now if you thought you were going to be paying 3%, you could be paying 5-6% before you know it.
Yeah.
And were you anticipating? Now I think people are probably stress testing, but 4 weeks ago, probably not all the way up to that level.
Which is a blink of an eye, as far as I'm concerned.
And especially when you've got earnest money that's already been deposited.
Yeah.
You're moving forward. You've made commitments. People are having to make some hard decisions right now.
Yeah.
And again, it's what we're trying to do is find the appropriate balance between risk and return. Okay. Because you can just say, no, let's just let it ride. Let's just go floating rate, no cap, no hedge, nothing, and we're going to see what's going to happen. And you know what? You might be just fine. The rent growth may just outpace the growth in interest rates, and the values will increase as cap rates stay low, and you'll be just fine. But I can paint a handful of situations where you lose your shirt in that scenario also. And I just personally, how I like to structure these deals is, I want to make losing not an option. It's it's difficult to show how we would lose money. Anything's possible.
You don't have to read the market.
Exactly.
Yeah.
We're not having to time anything.
Yeah.
Let's just what are these risk variables, and how do we either minimize them or just remove them from the equation entirely? So going fixed rate, maybe you have a higher interest rate at the beginning. Maybe it's even a little bit lower leverage. But you're not losing any money. You're actually making still pretty good return.
And I think that extends a little bit to just the broader economy in general. Uncertainty is a whole lot less. I like certainty a lot better than uncertainty. Let me put it that way. But yeah.
Yeah, and it's we'll probably be fine, but we could lose the deal. That's just not not a tenable option there. If you want to go for that asymmetric risk return, it's you're not getting the major upside, and the downside is significant. So it's you might as well, if in order to do that makes sense, but you need to have the appropriate risk premiums, the potential to get just a huge pop. And there's other places you can go to do that. You can go, invest in your favorite, cryptocurrency or altcoin if you're looking for the, to the moon 100x, or may go to zero. There's other places for that, and I don't think multifamily investing is the right spot for that. Okay, last on the report. This is just continuing to talk about just the markets changing. The Dallas Federal Reserve Bank of Dallas. Talking about real-time market monitoring finds signs of brewing U.S. housing bubble. Matt, are we in a housing bubble? We just heard all these fundamentals are so strong between supply and demand. They're saying, wow, it is a little bit scary and reminds them of the last housing bubble, or I don't know. It seems like we're pretty different, but what's their point?
So I think, and if And if this isn't in the article itself, I've read enough about these.
You're an expert.
I've read enough to know that this is not 2007 or 2008 or anything like that. This is, and any kind of bubble, even the worst case scenario, is not going to result in the kind of implosion that the housing market experienced in during those times. But that being said, there are some signs that, in terms of like what they're measuring here, is over exuberance in the housing market. If you scroll down on here on the thing on the article, they measure it specifically. But I just
before I do, Matt, I just want to read this. What is both? So it's an asset, in this case, housing is in the primary expansion phase of a bubble when price rises are out of step with market fundamentals. So that's the question we're answering here, right? Are we out of step of market fundamentals?
I'm curious how they define market fundamentals too. It's like, what is the fundamental thing? I think they do kind of try to
intrinsic value.
Yeah, and I think they also measure it as the proportion of price to income. But
That makes sense.
But they say, whatever their metric is, they've got a chart here that shows us where the line for housing prices falls above and below this 95% confidence, this housing exuberance. I don't know. It's hard to measure this. It seems like things were over exuberant from 1997 up until the Great Housing Crisis.
Yeah.
And so that's a long period of time. That's almost 10 years before the over exuberant price actually had a bubble bursting effect. And so by that measure, we are just beginning a long trek of elevated housing prices. Again, like, I'm not sure how they define fundamentals, but when you're talking about almost a decade-long period of high housing prices, there's, I don't know, I hate to say the word new normal, but it could just be that what their definition of fundamentals is it could be changed. It may be more flexible than what they're indicating here.
Yeah, because I think the major difference between today and 2006 was, one, that we actually have some kind of standards for lending. Yeah. And most of the home mortgages are, based on fixed rate loans, not floating loans. And then just a third is that there's so much equity built up into single family home owners. The prices would have to drop so far. People are saying the foreclosures are happening. Like, well, no one's being foreclosed upon because their house is worth so much more. Like, they would just if they would just sell it at this point. You wouldn't go through a foreclosure. You would just sell your house. Yeah. So that's the and then looking at, that's not even including supply and demand, that we just don't have enough housing. So I think looking at those fundamentals, I think it's different. But looking at just price exuberance and, almost looking at kind of overbought indicator, I'm thinking about kind of like an RSI indicator when you're looking at kind of X stocks and equities of basically, is it overbought or oversold? And I think they're basically saying that it's overbought right now. And that is true. And I'm just comparing this again to this, an RSI indicator when you're looking at equities. You can have something that's overbought, and it often declines a little bit or kind of reverts down. But continually being overbought means there's an incredible amount of demand. You can still see price movements going up. Not that there aren't minor fluctuations to kind of revert back to that mean, but it is often can be a very bullish sign that people are continuing to buy, and then it keeps coming into that upper band. And to your point about just looking back at history, that we were in this upper band for so long, back from the later 90s through the 2000s, just because we've just started this point in the cycle. I think, everyone, you would be insane to say that we'll never have some sort of housing correction or prices won't correct. That's just not how physics and money and economics, that's just not how it works.
And again, I'm not trying to disagree with them. They probably have a really good definition of fundamentals and everything, and it's definitely something to watch. But I think it is farther in the future than maybe the headline indicates. I'm glad that you brought up this chart here where it talks about price to rent ratio. That's one of the things I think is particularly maybe relevant for multifamily investors, and it shows there's a line where price goes underneath rent and where price goes above rent, and it's been underneath rent for quite a long time based on different calculations, and we're only recently since basically 2020 has home prices exceeded rents. Before then, it took what it was like 2008, where it was last consistently where prices were above rent. So it seems like rent either has room to grow, or if house prices take a hit, then they have a little bit ways to fall before the whole housing. It's like I said to you earlier, it's less of a housing bubble maybe than like a house bubble. Yeah. I think that rent is, as these charts indicated, if not insulated, then a little bit more independent when it comes to pricing.
Yeah. And I think there's another piece of, just looking at the price to income, it's certainly elevated, but it's nothing like it was in 2006.
Yeah.
Really.
Yeah. So it was above the bound again. So price to income was in that kind of quote unquote danger zone. It was a little bit shaky, but started in like 2002, and then it dipped below at around 2006, and so. There's still room to grow. It just seems like if there is a bubble brewing, this bubble is going to get a lot bigger, I think, before it bursts. And I don't know, there's a lot can happen in the in between. This is the beginning of a trend, I think, and that's why I want to keep watch on it. I don't want to ignore this, but I don't think it's necessarily cause for alarm as much as just keep an eye on it.
And I think that's a good point. Now, I guess one maybe kind of counterpoint to what we were saying of like, we got time.
Yeah,
we got
true,
time.
yeah.
And this is something I've thought about a lot, is that time is just compressed in terms of events and time, and we were using just temporal anomalies, in a sense that we saw years of growth, a couple years of growth within a single year, and the cycles potentially move so fast. I mean, people wouldn't usually talk about recession. We just had one in 2020, so now we're talking 2022. People were talking about a recession. It doesn't seem like the cycle has gone on long enough, but if we have so many things compress in time, things are taking half the time or a fourth of the time, then could we see some of these? We're using past periods may not be the best reference point, and it wouldn't be unsurprising that those timelines would accelerate significantly. So I guess that would be the only point that say that.
No, I think that's really true
to watch out for.
And when you look at these the trends that they're talking about, these events happen so infrequently that it's hard to base a trend off of maybe 2 or 3 major events. So
and so much of just trying to reading the tea leaves and looking at the crystal ball. And again, I think that if you have a long-term time horizon, giving yourself time in the control of time, being able to control your exit, removing as many risk variables from your business plan as possible, or at least mitigating those. It's again, it comes back to time in the market rather than timing the market. And this isn't necessarily telling us to time the market, and that's not what we're really discussing. It's more of understanding the current conditions in order to structure investments in a way that is conscious of the environment around us.
That's what I was thinking too. It's not necessarily are you in or are you out. It's addressing the specific factors that, whether it's rising interest rates or whether it's, increased investor demands, figuring out how all those little symptoms. And if you can address those, then that's going to be a whole lot better than trying to sum it all up and saying things are going to go bad or things are going to go good.
Yeah, I agree. All right, Matt, another great collection of reports, really keeping us up to date on the Gray Report. If you're interested in staying up to date, make sure you're subscribed to the Gray Capital YouTube channel over on YouTube. If you like to listen to in the car, this is available in a podcast as well. Ready to take the next step, hop on over to just gray.fund. Learn about the Gray Fund. It's only open to accredited investors, and this isn't an offer to invest. But we're putting together a great portfolio, 7 to 10 solid cash flowing multifamily assets in the Midwest. We're taking a more defensive approach to this, though. We're using fixed rate debt. We're doing lower leverage, really doing everything we've talked about today. We're putting it into practice of really mitigating risk and structuring things to really just eliminate the possibility of failure, or at least maximizing the chance of success. So really looking maybe a little bit more conservative than we were in the last couple of years, but I think given the uncertainty, I think it's appropriate, and actually the kind of the change of strategy has been extremely well received from our investors.
Yeah.
I think it makes a lot of sense to a lot of people, makes sense to us, and again, we see ourselves as stewards of these assets and our investors' capital, and it's not a time to be playing games and just going just taking just any risk just to get a high return on a pro forma. It's just not safe. So just check it out, gray.fund. But don't forget about grayreport.com as your number one source for multifamily news. It's the number one multifamily intelligence aggregator on the World Wide Web. So check it out, grayreport.com. Again, there's 3 things we're telling you to do. Besides, like, subscribing, giving us a comment, but subscribe to the newsletter, graycapitalllc.com/newsletter. All these links are going to be in the description, though, below. Gray.fund and grayreport.com. You get the trifecta, all the Gray Capital information, really helping you stay up to date. Matt, again, wonderful report. Great to have you back in the saddle.
Good to be back.
We will be back next week bringing you more up-to-date information and the latest research reports relating to multifamily, real estate, and the economy. See you next week.